Hey guys, welcome to the channel. Welcome back to another video. On today's video, I'm going to be talking about my top 5 ETFs that I would buy as a beginner who's starting sort of late in the process in terms of investing, right? You're over 40 years old and you want to start investing, or you want to get more serious about investing on your own outside of your 401k, outside of your 403b, outside of your thrift savings plan, whatever it could be. So on this video, I'm going to be talking about these 5 different types of ETFs. Okay. Now, I'm also going to be saying, hey, why ETFs for older beginners, right? What's the purpose? Why are they so much better, in my opinion? And then I'll talk about the top 5 that I like. And then I also talk about, we'll be pulling them up, looking at them, seeing them, maybe going over them, comparing a few of them. And then we'll talk about what to look for when you're choosing ETFs and you're a beginner. Guys, let me know you can hear me okay. Give me a shout. Give me a thumbs up if you can hear me. And let me know what city, state, county you're in. I appreciate you letting me know that. I always like to see what our group of people are coming from. So we're going to be talking about large cap ETFs, mid cap ETFs, small cap ETFs a little bit. We'll talk about growth ETFs, value ETFs. We'll talk about sector specific ETFs, and even bond ETFs. We're going to be talking about these all in the course of having this quick conversation. It won't be a terribly long video. And then, hey, why ETFs? Let me just give you this flat off the bat. ETFs, lower fees. So lower cost, they're cheaper to own, means more money in your pocket. ETFs, lower risk, right? Less volatility, a lot more diversification, because you have an ETF is just a bucket. And in that bucket is a whole group of stocks, a whole group of companies in that bucket. So when you have a whole bunch of companies in one bucket, you got more diversification than if you just have one company. So there's a little bit lower risk, and then there's lower volatility. You don't see these big swings like you might see Nvidia go from $99 one day to $130 the next day. You don't have those swings when you have so many things in the bucket, so many different companies or stocks in the bucket. Lots of diversification. That's why I like ETFs. But this is the absolute biggest reason I like ETFs. You spend less time researching. There's a lower learning curve. There's less knowledge that you have to be good at investing in ETFs than you have to be than if you have individual stocks, right? So less knowledge is needed. That means it's better for beginners who may not have some of the acumen of being knowledgeable, overly knowledgeable about how to research stocks and how to read free cash flow and all this good stuff, right? PE ratios. You don't need to know a lot of that stuff when you're investing in ETFs. And a lot of older people, frankly, guys, flat out, a lot of people who are older, I say we because I'm sort of in that category. We don't want to be sitting in front of computers all day and technology and pulling up a phone every 2 seconds to check on our stock, right? Or track our stock movement throughout the day. Just don't want to do that. You don't have to do that with ETFs. The other reasons I like ETFs better, accessibility, right? Meaning that you have access to different classes, different sectors, different types of markets, small companies, large companies, etc., right? So, and it's good for like retail investors like us to have plenty of exposure to a lot of different stuff that's out there and a lot of different strategies, right? The other thing is this: ETFs are very transparent. You know what's in the bucket. Nobody's pulling a fast one over on you. The holdings that are in the bucket are public knowledge. You can go anywhere and figure it out. Finally, I like ETFs because they're less stress, less emotions, less strategy, less trying to guess and time and chase and jump in and jump out and buy a dip. And you ain't got to do none of that, right? With ETFs. Typically you can if you want to, but you really don't have to do any of that, right? So there's less panic if something crazy happens when you're talking about ETFs, right? So that's why I like ETFs better than individual stocks. So let me clarify up front. I'm going to be talking about small cap, large cap, mid cap. What are the caps, right? Small cap companies, small cap ETFs invest in companies with a value, I think, of less than, help me guys, 2 billion, I think. Companies that have a value of less than 2 billion are in the small cap strategy or small cap category, right? There's more risk with small cap. These are small companies. So there's more risk. more volatility because they're more sensitive to what's happening in the market. So a small company, when you're talking about small cap ETFs, there's more risk involved with small cap. And that's one of the reasons that of my top 5 ETFs that I would buy as a beginner over the age of 40, I wouldn't buy small cap ETFs. That's not on my list. So we can take small cap ETFs and we can wheel it out to the curb and just push it out into the middle of the street, because I don't buy ETFs that are small cap. Now, if you want to, cool. I'm not mad at you. But I wouldn't really suggest small cap ETFs for beginners that are older, over the age of 40. Now, mid cap ETFs invest in companies between, is it 2 billion, companies that have a valuation of 2 billion to 10 billion, I believe. That's mid cap, right? Obviously, a little more stable, less volatility. Small caps are doing this, up, down, way up, way down. Mid cap is doing a little bit of this, right? A little less volatility, a little more stable, right? Because you're talking about middle of the road companies. A lot of them, you've heard of them, a lot of you haven't. Then we got large cap ETFs. Now, large cap ETFs are investing in companies. In other words, the companies in that bucket called the ETF, the large cap, those are companies with a valuation over 10 billion. And so they're typically a little more stable, right? These are big companies that you've heard of, right? The Home Depots and all that good stuff. You've heard of these companies. So we're looking at all 3 of those different sizes of companies when we're talking about investing in ETFs, my top ETFs. And these large cap ETFs, they're better for beginners, guys, because they're a little less risky. If that makes any sense. So let me see what we got in the chat, guys. Hey, what's up to you? Rich O'Cat. Willie Wilo's here. Good to have you. Validated. Thanks for the thumbs up. Appreciate it. Orlando's here. Good to have you guys. Looks like we got a good crew in here. Brooklyn in the house. Crystal's here from California. Baltimore, Maryland's in the house. Good to have you. Southern Indiana's here. So appreciate you guys being here. And feel free to talk in the chat. We're just going to run through these top 5 and have this conversation. And hey, thanks, Mrs. Moore, for being in the house. Good to have you here, guys. Don't forget, go ahead and hit the like button for me, and we'll keep this thing rolling. So I just wanted to kind of preface all the stuff we're going to be talking about with some of that upfront information. So number 1 on the list, let's jump right into it, guys. Number 1 on the list, and this is what I think is probably a staple for all beginners over the age of 40. The number 1 on the list is what I would call it is what's called a large cap growth ETF. My favorite, and some of you can attest to this, might be your favorite, is just an S&P 500 large cap ETF. So if you're on Vanguard, you're talking about VOO. If you're on Charles Schwab, I think you're talking about SPY, right? And then, of course, IVV. There's a large cap S&P 500 on a lot of different platforms, and you can find them. The beauty of it, well, let me actually pull it up. Let me share my screen with you guys. I got another screen up here. Give me a second here. Let me see if I can share my screen with you. And let's just look at VOO, right? How about we just do that? Let me find it. Boom, there it is. Whoop, there it is. All right, there's VOO. I'll pull it up. If you're not able to share my screen or see my screen, guys, you can come over here on YouTube at Smart Money Bro on YouTube, and you can look at it there. Let me see if I can make it a little bit bigger. There it is. All right, so Vanguard, and I'm going to be looking up here because on the bigger screen up here. All right, so Vanguard, S&P 500 VOO. VOO. All right. So it's a large blend. By the way, that's the ETF, by the way, not the index fund, mutual. The ETF specifically is VOO. And how do I make this thing even larger? Give me a second. There it is right there. Okay. So the S&P 500, guys, basically tracks the performance of the 500 largest U.S. companies across a number of different industries or sectors, right? Technology's in there. Healthcare companies are in the bucket. Financial companies, consumer staples companies are in the bucket, right? So when you invest in an S&P 500, right, you get instant, in my opinion, you get instant diversification, right? Instantly, you have a tool in terms of an S&P 500 ETF that reduces the risk of just poor performance, right? Because you can have a poor performer, but if it becomes a poor enough performer, it gets kicked out of the S&P 500, and you don't have to do anything to watch it get kicked out, right? So the S&P 500, in my opinion, is the absolute number one ETF that any beginning investor over the age of 40 should invest in. It's stable. It's the largest companies in America and almost in the world, but you're talking about basically a low volatility ETF compared to individual stocks of some of the other ETFs we'll mention. So it's a relatively safe. Now anytime you're dealing with money, risk is involved. So it's not risk free, right? But it's a relatively safe place to have your money if you believe that the largest 500 companies in America are going to continue to grow and grow and grow, which they've continued to grow and grow and grow over the long term for the last 150 years, right? 140 years or so. So S&P 500 ETF, low expense ratio. Let's just run through it. Index fund, or they call it an index type of fund, but it's an ETF. Large blend, 4 out of 5 risk, which means it's, a little bit risky, but not super risky. Super duper low expense ratio, that means it's cheap to own this particular ETF. Doesn't cost you a whole lot to own it, right? Let's look at its holdings real quick so you can kind of see. Let's look at performance first. All right. So at performance down here, guys, you can see, and hopefully you can see on my screen, but 10 years, nearly 13% return. 5 years, almost 16%. This year, over the last year from today, 27% return. Huge. Year to date, from January 1st to today, 19.37%. Okay. Now, the last month or two, if you look at that, sure, it's at 3 or 4% because everything's down a little bit in the last 3 or 4 months or so, or less, 2 or 3 months or so. But that's sort of what the performance looks like as we go through it. Let me just actually look at the portfolio composition. Let's look at the holdings if I can find. Okay, so where's my deal? So basically it's this, all right? So VOO, let's see here. Boom, boom, just pulling around, just looking also and see what you guys are doing there. Huh, interesting. All right, so let me see about sectors here. Give me a second here. What did I do? I went out of it. Give me a second here. Let me pull it back up. So bear with me. All right, there it is right there. So I'm going to go down here to portfolio composition real quick and see what's in the bucket. What's in the bucket? Okay. When you look in the bucket, 31% of it is IT, information technology. So it's sort of heavy. Remember, this is a growth ETF. S&P 500 is a growth ETF, which means basically that it's in the bucket, the 500 companies or more in the bucket, they're sort of expected to perform above the average, right? So therefore, we're looking for these companies to grow, right? 31% is IT, 13% is financials, 10% is consumer services, etc. So some of the largest holdings in the bucket, because this is a weighted ETF, all these are weighted ETFs, meaning that the bigger the cap, large caps, they hold more weight, right? So Apple holds almost 7% of the weight in there. Microsoft holds 6.5%. NVIDIA holds 6.2%. So just in those 3 companies alone, that's 19% of the S&P 500. So for a beginner, so you don't have to sit there and choose and pick and, well, when should I get rid of Apple? When should I get rid of Microsoft? Okay, when should I unload some of this Meta or some of this Google, right? Alphabet. You don't have to do all that. If Tesla goes from being in the Mag 7 to out of the S&P 500, you didn't have to guess when to sell it, right? It just moves out on its own and it kind of gets automatically replaced with a new company. But if you own an individual share of Tesla, If you don't get rid of Tesla before it drops down to $5 per share, then you will have lost a ton of money. Again, in ETFs, you don't have that guessing, that guesswork that we have typically with other types of single stocks, right? So that's why I like this particular ETF as one of my favorites for all new beginners, right? All new beginners, right? Very important, in my opinion, to have a little bit of your portfolio allocated to the S&P 500 for the long term. If you believe that companies in America, the top 500 companies, whatever they may be, that's going to be in your bucket called VOO or SPY, if you believe they're going to keep going up, you should probably have a little bit of VOO, in my opinion. All right. Now, let's go to the next one. Let's get out of this one. Let me see if I can stop sharing my screen real quick. Bam. And let me go to the next one. Number 2 on the list. Let me actually make myself bigger. Number 2 on the list. The second ETF I would buy as a beginner over the age of 40 is what's called VYM, also known on Schwab as SCHD. Ticker symbol is SCHD. And if you have any of these guys, let me know in the chat if you have them. QQQ, not bad. I see you, Jimbo. QQQ is not bad. We'll talk about it. Large cap value. So S&P 500 is a large cap growth, but VYM and SCHD, depending on which one you care to have, those are considered to be large cap value as opposed to large cap growth. I said S&P is a value. S&P 500, the first one is a growth ETF. This one is a value ETF. Now, when I say value ETF, I mean it's a little more, it's long-term companies that are in here that provide you a nice, solid, good dividend in VYM or in SCHD. So VYM it still focuses on those large companies, right? But it's larger companies that are a little more stable, don't have a lot of volatility, and they pay high dividends, right? These companies tend to have like stable earnings, and they distribute a nice portion of their profits to shareholders in the form of dividends. So VYM and SCHD are considered dividend ETFs, right? And as an investor, a new investor, it's nice to be able to either get those dividends in the form of a check, or get those dividends in the form of a check or deposit, right? Or get those dividends reinvested right back into the shares of the ETF, right? So that's why I like VYM. Oh, let me say this, full disclosure. I have in my portfolio pretty much every ETF that I'm telling you about. So I'm not just talking here. These are ETFs that I have. And so because of that, that I feel a little more strongly about these because these are actual ones that I hold. So VYM, solid. And I can pull VYM up. Give me a second here, guys. Let me see. If you guys don't mind that I pull it up, let me see. I want to pull up VYM just so you can see it. Let's see here. Let's go here and let's go there. All right. So, and I'm going to actually do the split screen again. So let's pull up VYM and make it bigger. I'll just make it big. All right. So VYM. All right. Vanguard High Dividend Yield ETF. This is number 2 on the list. Again, low expense ratio. Currently trading at 126.95. Looking at the performance real quick, and I'll just show you the performance. Not that performance is the greatest thing in the world, but it's good to see and take a look at. If you look at the 10-year of the VYM market price wise, 9.93% return, 5-year 11.62, 3-year 9.15. Anytime you look at a 3-year return right now, remember it includes the year 2022, and the year 2022. The whole market was down. The S&P 500 was down by 18%, negative 18% for the year of 2022. So that skews everything under this 3-year down pretty low, right? Or lower than the other years. If you look year over year, it's at 22% return. That's huge. If you look year to date since January 1st, it's 15.69%. That's pretty good, right? That's pretty solid for a value ETF. A value ETF, meaning that you can avoid some of the volatility that you see occur in a growth ETF, right? So I'm a big fan of VYM. And if you want to sort of look at where that would be on the equivalency, SCHD would be it. But let's look at some of the portfolio composition. What's in it? Oh, by the way, Vanguard does this large value, right? Kind of let you know that. Okay, so what carries the most weight? The financial sector. This is your Capital One, your JP Morgan, your Bank of America, all those things that offer financial services, those businesses carries about 21% in this particular ETF, right? And you think about it, it just makes sense, right? That if you look at the top 15 banks in America that are in the top 15 lending institution, 10 or 15 lending institutions, they don't go anywhere. They're pretty stable and have been around for years and years and years. I know we had some bank collapses a while back, but for the most part, financial companies are pretty stable. Energy is in here at 10%. Consumer staples is in here, almost 11%. You got consumer discretionary in here. These are the sectors, right? Technology is only 10% of VYM. Look at some of the companies, top 10 holdings, or at least some of the top holdings. Broadcom's up there. But then you're talking about JP Morgan Chase, Exxon Mobil, obviously energy, Procter and Gamble, Johnson, right? These are companies that you've been hearing about for the most part for 30, for 40, for 50 years, right? Exxon, JP Morgan, Procter and Gamble, Johnson and Johnson, Home Depot, Walmart, like Coca-Cola. These companies have been around forever. And that's what you get when you have a value ETF, right? Good, solid, strong dividends, good, solid, stable companies that have been around forever, right? Some of the dinosaurs are in here, but the dinosaurs are in here giving you a high dividend return, right? Paying the shareholders well. These are companies that pay their shareholders pretty well in terms of their dividend yield. So VYM is number 2 on the list, in my opinion, for top 5 ETFs to buy as a beginner over the age of 40. All right. Now, let me go back here. So, okay, now number 3. I'm just running through them, guys, as you can tell, right? I'm not going to make this a very long video, but certainly one that's going to be impactful. And if you get a chance, share the link with somebody, right? Now, let me say this because I didn't say it before. I am a fan of making sure that when you have a dividend paying ETF like VYM or SCHD, that you really strongly consider reinvesting that dividend. Okay. Because if you look at all the models, and there's models out there, I'm not going to pull any up, but if you look at the models and so forth, they show you that when you take that dividend, okay, that's cool. You take a little dividend, but if you leave that dividend in and allow your stock along with your dividend to compound over the course of 15, 20 years, the compounding effect is huge. And you end up with so much more if you take that dividend and reinvest it back into the ETF. So just a little something for you guys to think about if you're looking at an ETF like VYM. All right. But VYM is solid because, in my opinion, it holds really a broad range of large companies that pay good dividends, but at the same time, there's a lot of diversity. It's not really top heavy, except for the 20% in financials. But, you know, it's got a good mix of consumer stuff and healthcare and IT and all that stuff in there. And so I like it a lot. And so, in my opinion, it's kind of an inflation hedge, to be honest with you. Now, let's go to number 3. The third one on my list is I did a couple of large caps, VOO, VYM. Number 3 on my list of top 5 ETFs I would buy as a beginner over the age of 50, over 40. And that's important because when you get over 40 years old, you sort of want a little bit of, you want a little less risk, typically. Now, everybody doesn't do that, but kind of the typical way of looking at it is the older you get, the less risk you want. So number 3 on my list is a mid cap value, and I like VOE, and I own VOE. VOE is, I think some of its equivalent might be IWS. Maybe it's a mid cap value ETF that offers solid growth potential. These are mid-cap companies, so not the huge Home Depots and Procter and Gambles and all those, right? Eli Lilly's and all that. These are mid-cap companies, so these are not super large companies, but they also are companies that do have some room for growth. They're value mid-cap companies, right? And they often outperform some of the large cap value companies, right? what VOE does as a ticker symbol VOE at Vanguard, it sort of focuses on some of those undervalued companies that offer good bang for your buck, but you may not have heard of them because they're sort of mid cap, right? And it spreads it across several sectors. Let me pull it up real quick. Let's actually look at VOE. VOE is my suggestion for a person that's over 40 years old who is looking to invest sort of for the first time and not super duper well versed in this thing, right? So let's look at VOE real quick. Now, VOE, let me pull it down real quick because it's hanging up there and it needs to be a little bigger. All right, so VOE, Vanguard's mid-cap value ETF. Remember, growth versus value. So we got some growth in our S&P 500. We got some value with our VYM, and we get a little more value with VOE. And you say, why are you hanging on value instead of hanging on growth? Because again, over 40 years old, over 50 years old, you may not want the volatility of having a heavy amount of your portfolio in ETFs in growth. You may prefer to have a heavy amount in more value. And that's why we're talking this. Now, if I was having this conversation with people who are in their 20s or early 30s, I might be looking at more. I may not have VOE. I may be looking at another growth ETF. But because we're talking about beginners who are older, that's why I threw in VOE as one that I actually own as well. So it's a mid-value domestic stock, and it goes through all the stuff. Low expense ratio, still very, very inexpensive. And that's what it's trading for right now, 165. Let's go ahead and look at performance real quick. So in terms of performance, look at its 10-year. That's long-term, almost 9% return. That's not bad, right? And then you look at its 5-year, 11%, 6-year or 3-year, 6%, 6.5%. But 1 year over year, almost 22%. Year to date, almost 15% or 14.5%. So, and I like to look at these 10-year because I'm looking at ETFs in terms of holds, right? If you're 50 years old and you're buying ETFs for the first time, you're probably going to have them for 10 years, right? 10, 12 years, 15 years or so before you start touching them. So the 10 year is always nice to look at. So not bad on the 10 year at almost 9%. If we come down here and look at what is in it, what does it have in the bucket called VOE? We're talking, 17% financials again, 19% industrials, right? And then we're talking 7% healthcare. We got a little bit of real estate. In REITs, we got only 6% technology. We got 10%, 11, almost 11% consumer discretionary. But let's look at the actual companies. Now, again, you haven't heard of a lot of these companies because these ain't the big boys. Arthur J. Gallagher, Newmont, D.R. Horton, PG&E Corporation, Allstate is in there. Some of you might have heard of Allstate or even United Rentals or Digital Realty. But United Rentals, I think they rent out equipment or so forth. But Allstate, of course, we heard of Allstate. But here's the deal. Not household names right here, but still very, very steady companies that offer great value, often undervalued. See, you don't hear about the Newmont Gold Corp, right? You don't hear about Carrier Global. You don't hear much about United Rentals in the news making a splash because it's not the Microsoft and the Nvidia, but it's still a solid company. The thing we got to do as investors, as older investors, we got to remember this, guys. Just because a company doesn't make the news doesn't make it a bad company, right? Just because it's not growing like Nvidia doesn't mean it's a bad investment, or for some reason this is not a good place to put your money because you just haven't heard about it. There's hundreds and hundreds and hundreds and thousands of companies that you have never heard of that are growing and doing a great job. And so that's why I want you to that's why with this one I threw in VOE as a mid-cap value because it has some of those undervalued companies in it, but it still gets you pretty good growth, right? Still gets you some growth and some solidness to your portfolio. So VOE is number 3 on my list of top 5 ETFs I would buy as a beginner over the age of 40. All right. Now, number 4, moving to number 4 here. Number 4 is this. It's your choice of a sector specific ETF. You choose. Okay. As a beginner ETF, I'm a beginner ETF. You better not be a beginner ETF. As a beginner investor who's over the age of 40, who's looking to buy some ETFs, you can sort of make some decisions on your own in terms of what sector or what industries are you comfortable with. Maybe you've been a nurse for 15, 20 years. Maybe you've worked in the hospital as a radiation tech or whatever, at admin at the front desk, whatever it could be, right? And you understand healthcare and you understand that sector, that industry, then maybe you can invest in a healthcare ETF, right? I mean, it could be anything. It could be maybe you understand real estate and you want to look at some REITs and you want to do a REIT specific sector ETF, right? But I want you to be able to choose an ETF of your liking in the sector that you think is best for you. That's my number four, right? What are the different sectors? Let's think about it. Help me, guys. Technology, right? These are companies that, okay, if we looked at a technology ETF at Vanguard, we'd be looking at maybe what VGT or MGK, where 50 to 60% of that ETF is consumed in the bucket of companies that are heavy in tech, right? If you understand technology and you understand the workings of software companies, hardware companies, TSMC, NVIDIA, and you really understand Apple and Microsoft and you name it, right? Then maybe you want to invest in a sector specific technology ETF. Maybe it's healthcare, like I said. Maybe it's financials, like I said, banks and insurance companies and asset management companies and lending institutions like Goldman Sachs or JP Morgan, Bank of America, whatever. Then if you understand that, maybe you were a banker for 20 years, right? Maybe you worked in retail for a long time. And that's what consumer discretionary is, right? So maybe you sold automobiles or you sold name it. You worked at Target, you worked at Kohl's, you understand the retail space and what the numbers mean, then maybe you can invest in a consumer discretionary ETF, right? Or maybe a consumer, what they call consumer staples, which is goods like food and beverage. Coca-Cola is a consumer staple, right? And all those type of companies would be in the bucket. Maybe it's energy. You worked out in the oil fields and at for whoever, and you understand BP, you understand Chevron and Exxon Mobil and all that good stuff. Oil and gas, you get it, you know it, you've been in that industry. Maybe you want to invest in an energy ETF, utilities, transportation, right? Again, real estate, you name it, communications, you understand telecom and communications, AT&T, etc. So for number four, the fourth ETF I would buy as a beginner over the age of 40 is a sector specific ETF that you understand and you know, and you feel comfortable with the companies that are in the holdings, right? I hope that makes sense to you guys. Let's see. I'm looking back at the chat here. What are some healthcare ETFs? There's a bunch of them out there. Guys, you got to do me a favor, at least. And I just jumped right into it. I didn't go into it. Hit the like button for me. Just take a second out and hit the thumbs up button for me. If you're watching this anywhere else, come on over to YouTube if you want to see my screen and hit the like button. And if you have a question, feel free to drop a question. I'll be more than happy to answer it for you. Just looking at some of these chats here. Okay, number five. Let's go to number five. Now, for people that are older, I'm talking 40s, 50s, 60s. For people that are older, the older you get, the closer you are to needing the money. And the closer you are to needing the money, the less volatility you want to have in your portfolio. Meaning you don't want these temporary swings that's going boom, bam, boom, bam. You want to keep everything kind of like boom, boom. We can do this right here, right? But we can't be booming and bamming or bamming and booming. But we can keep it kind of even keel. So my fifth ETF that I would suggest somebody over the age of 40 consider, don't beat me up, but I got to say it because I think it's important, is consider a bond ETF. Now, when I say a bond ETF, I'm talking about some stability with your money that is not susceptible to the large swings. And when I say a bond ETF, I mean a small percentage of your allocation in your entire investment portfolio in that bond ETF. So I don't want you to have 80% of your money in a bond ETF, but I wouldn't mind you having, depending on your age and your risk tolerance level, 5%, 10%, 20% of your money in a bond ETF as you get older and older. And you can increase that percentage the older you get. If you're 75 years old and you're watching this, I would not mind you having 40% of your money in a bond ETF. But if you're 45 years old watching this, I don't want you to have 40% of your money in a bond ETF, right? And this sort of brings up the whole question of allocation, right? Allocation, allocation, allocation. How much of your portfolio should be in this and how much of your portfolio should be in that, right? So let me look at a bond ETF. Now, this bond ETF, I actually own BSV, but I'm thinking about getting rid of what I have in BSV and moving it over to VGSH over on Vanguard. Let me just show you. Let me pull that up real quick and share my screen with you real quick, because I want you to understand, guys, that most people are not going to have this conversation with you about a bond ETF, right? So you can call me names if you want to, but I'm trying to do what's best for you and tell you how it really works out here in the world, as opposed to how it works on the internet world, which could be different. In the real world, you have to be thinking about allocation, right? And so you have to be thinking about how much of my money can be a little more secure in a place like a bond ETF, right? So in my opinion, that's why I wanted to bring this up, right? That's very important to me. Let me actually, if I can get to it here, give me a second here. So, all right, there it is right there. All right, so bond ETF, short-term bond. I'm looking at VGSH in particular, still low expense ratio, still low price, but I want to look at the performance because I really want you to be alerted to this in terms of performance. Now, notice the percentages: 1.27, 1.26, less than a percent over 3-year, 5-year, or 5%, almost 6% for the year over year, 3% for year to date. Now, these rates of return are much, much lower. But here's the kicker. The reason they're so much lower is because this is 100% US government bonds, meaning that they're about as low risk as you can get, right? Why do I care about you having a piece of low risk, really, really, really low risk that's only going to give you 1 or 2%? Look, if you're 80 years old, you may not care about growing your portfolio over the next 20 or 30 years, right? Flat out. You want to get your money and use your money, and you want to hedge against the stock market crashing. And if you got 30 or 40% of your money into a bond ETF, then that's going to guarantee about not guarantee, but it's going to probably give you 1 to 2% over the next few years while you live out your life. You don't lose all your money. This is why you want to consider to have a bond ETF as a small allocation of your portfolio. The younger you are, the less you should be thinking about this. If you're 25 or 30 years old, you ain't got to have no bonds in your ETFs. But if you're 45, 55, 65 years old, you need to possibly have a tiny little percentage in bonds. I don't care if it's 10% so that you're split 90-10, or if it's 80%, so you're split, 20%, so you're split 80-20, 20% bonds, 80%, equities or stocks, etc. So I wanted to point this out to you because it's important, and you just don't hear it often on the internet. Because for me, I don't know about you guys, but a lot of stuff I see on the internet in terms of investing, it ain't for people that's 45, 55, 65 years old. It's for people that are 20 and 15, 20 and 25 and 30 years old. But sometimes we got to look out for us older folks that are getting older, right? And so that's why I wanted to introduce you and say, look, please consider at least thinking about having a piece of your portfolio in the bond market. in a bond ETF that you feel comfortable with and you feel safe with, right? So that's my top 5 right there. Okay, let me see what we got in the chat here. Let's see, boom, boom, boom. And again, this is not going to be a super long video, guys. It's going to be fairly quick, right? But I like bonds, and I had to bring it up to you, so don't beat me up. But bonds preserve your capital. Bonds hold on to your money, right? Bonds do. They hold on to your money. Bonds provide people that are a little older with a little, I'm not saying having all your money, just a tiny percentage of it, right? So my top 5 ETFs: large growth ETF like VOO, large value dividend paying ETF like VYM, mid cap value ETF that's sort of steady with some of those old school companies, but they still doing well in terms of actually how their returns. VOE. My 4th choice was a sector specific choice. You choose. My 5th choice is a bond like a VGSH that I showed you, or a BLV or a BSV. These are bond ETFs. Now, again, why ETFs? Lower fees, lower risk, lots of diversification. Big one, less time spent researching, right? That's better for beginners. Better for people who don't want to constantly look at their stocks and get stressed out over them every 2 days, every 2 hours or whatever. Accessibility. You can get to any different type of sector or asset class or market through an ETF based on your investments. Transparency. You know exactly what's in the bucket, what's not in the bucket. Less stress, less emotions, right? Less trying to guess and jump in and jump out. What are you going to look at when you look at ETFs? Expense ratio. Is it cheap to own? What category is it in? Large, small? Is it value? Is it growth? What does it hold? What's in it? Vanguard calls it competition or composition. Other places might call it holdings, right? What's in the bucket? And how much weight does each company in that bucket hold? Also, overlap. Don't forget, when you're looking at ETFs, you're over 40 years old, you're a beginner, look at overlap. You don't have to hold VTI and VOO. You don't have to have SPY and VOO. It's the same thing. So be careful about overlap, right? Having the same companies in 2 different buckets. You got SPY right here with all these things. Then you got VOO right here, and it has the same stuff over in SPY. And listen, you don't have to get 5 ETFs. You can get 2 ETFs, right? You can just invest in the S&P 500 with 1 ETF, right? But you want to look at past performance, what sector it's in, the price, obviously, if you're concerned about the price. And also, here's the kicker. Does this ETF fit my strategy? What is your strategy when you buy ETFs? And also, finally, when you're looking at ETFs, what is the allocation, right? 90% this, 10% that, 30% value, 40% growth, 10% bonds, 20% do whatever you want to do sector specific. You come up with your own allocation that fits you, right? If you learn this stuff well enough, you don't need an advisor to tell you that, right? You really don't. But allocation is key. Let me see what we got here real quick, guys. Boom. Let's see. I get boom, 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 boom. I'm just going to see what we got in the chat. Any questions? Put a Q there, guys. Do me a favor. Make sure you hit that thumbs up button. Let's see what we got. Somebody said TLT, good mix. We got a lot of good stuff in this chat, guys. Hey, Artemis from South Holland, Illinois. Good to have you here. Listen, we got a lot of good information. If you're watching this on the return, or the respin, what do they call it? If you're watching this on the replay, I said rerun and respin. If you're watching this on the replay, read the chat. There's some great information in the chat that you might want to know. Somebody said, so somebody said, what's the difference between buying individual ETFs with bonds versus a target fund? It's the similar blue butterfly. It's a similar concept, right? A target fund is typically when, as you get older, they automatically adjust your allocation to hold more bonds and hold less, individual stocks or less growth type ETFs. They shift, and they shift it behind your back without you even knowing they're shifting it as you get older, right? You're 30 and you start off with 10% bonds, and you don't look at it again until you get about 60. And then when you're 60, you got like 50% bonds or 60% bonds, right? They're just shifting it behind your back. Same concept. What I'm saying though, with what I would do as a new beginner is if you're doing these allocations on your own, you can begin to shift on your own, right? You don't have to wait for them to do it behind your back. But so the difference between buying individual ETFs with bonds versus a target is it's sort of the same thing. Target funds is where they're doing it for you, and buying it is obviously where you're doing it on your own. Very good question. Let's see here. Let's see. What's the S&P 500 rebalancing that's happening on Friday? I'm not aware of it. Didn't read it, but I can definitely maybe address it on when we get back together on Thursday, because we're going to have another another video on Thursday. So we'll talk about that then for sure. So I didn't want this to be a long one, guys. I want this to be fairly short, to the point blank. This is what I have for you in terms of 5 ETFs I would buy as a beginner who's starting over 40. Right? And even if you're in your 30s, these are ones that you should be thinking about and considering as well. If you got anything of value out of this video, I'm going to need you to hit that like button for me. Also, look in the description box. I got free stuff down there. All the stuff. I appreciate you guys being here. I appreciate you, Nelson. I appreciate you, Pablo. I appreciate you, Robert, Mrs. Moore, Blue Butterfly. Thank you so much for being here and checking in with me, guys, on this, Monday evening. I appreciate you also, Miss Reynolds, being here as always. Good to see you. Brian, appreciate you being here. So if you got anything for me, drop it in the comment section. When this video's over, in an hour, 2 hours, I'll go read the comments, right? Yes, I still do one-on-one conversations. You can join my Patreon for a monthly one-on-one where I'm sort of the accountability partner, holding you responsible, kind of the mentor or coach for a lot of people. But also you can do a one-on-one with me for one time. Just jump on my schedule. A link is in the description box below. You'll find it down there. I appreciate you, Mrs. Moore, for taking care of the chat for me. Appreciate you guys for being here. And as I always say, the absolute best person to take care of the old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.